Welcome to Whole Life Insurance Mechanics from the perspective of Nelson Nash's infinite banking concept. I'm your host and lecturer, Ryan Griggs, and this is part 7 of 7, our series conclusion. Y'all made it. What all have we learned? I did my best to put everything on one slide, but truly we covered a lot. I said at the very beginning that the idea for the course was to take my method. It was to take the stuff that I find clients or potential clients need to go from having caught the IBC, having read Becoming Your Own Banker, having enjoyed and accepted what Nelson was teaching and wanting to actually implement it in their own lives. And I think there's some information that is helpful in guiding the policy purchase process, and in fact can be instrumental in determining the right company from which to purchase a policy, the right premium level, the right structure of that contract, the right term rider, the right premium structure, the right allocation between base and term and PUA. And I wanted to approach this in a fashion where I don't just tell you what I think, but I tell you why and how I arrive at those certain conclusions. I know that takes longer. This isn't a ClickFunnels. I'm not asking you for emails or anything. It's not. I know, and trust me, plenty of people have told me you're crazy for just putting stuff out. Okay, well, it is what it is. I think people should know this. I'd want to know it if I was starting. And so I've tried to tell you why I think what I think. And I know I come across tough at times and harsh or whatever. At least some people have said that. And you might agree, you might not. But, like I said, I come with my opinions, can't get them off me. But you don't have to agree. I hope that by putting out my rationalization, my reasoning, my arguments for why I've come to certain conclusions. And by the way, the reason I started with that stuff before I even told you, or asserted to you what I thought, is so that you can choose to adopt that way of thinking, or you can specify the points at which you disagree, and you might, like James says, I'm not the IBC police, and the stuff in this lecture is not all just IBC, right? IBC is not just about policy design. But policy design is a question. We didn't have term writers 40 years ago. We didn't have PUA writers 40 years ago. The idea of a premium structure is new terminology. There's not even a formal way to talk about it. So we're learning. We as the sort of the market in general, we're learning how to talk about this stuff. And so I think that requires a more in-depth, maybe at times long-winded, I hope it wasn't too brutal, treatment of these questions. And you can come to your own position. I would just prefer that you come to well-reasoned positions. Part of the reason that we have modified endowment contracts is because the dividend-paying whole life industry did a pathetic job of explaining what their contract, what their product, what their offering really is in the 1988-86 proceedings. In the Senate subcommittee on debt and finance. And you can go, the recordings are on C-SPAN, and the documentation is shown. You can find it on public archives of what was entered into the record and so forth. Weak explanation of what was offered. And the result of that were all these restrictions. What we now call modified endowment contract rules, which is fine. We manage it like you saw in the charts. You can still build a whole lot of cash value. Like Nelson showed in Becoming Your Own Banker, you can still take control of the banking function. No question. Right? But if we know our subject well, both as professionals in the business and consumers, everybody wants to be better educated and better informed about what they're doing, especially when it comes to their money. So if we can do that, I think that's the best way to ensure the longevity of the business, right? To make sure that this kind of stuff is available for the generations that come after us. And in a sense, I think it's the best way to serve Nelson's legacy. We started with philosophy. And I hope you could see at various times throughout the lecture series that we continued to go back to that. I want to pay premium for as long as possible. I want to maintain flexibility. I want to maximize control. All these things assume a certain philosophy, a certain approach to policy design. And if you don't share that philosophy, well, then we're going to come to divergent conclusions about what the appropriate approach to policy design should be. And that, I think, is the reason why there's this animosity or vitriol or just intensity of disagreement between people who want to do one structure or one policy structure or one premium structure and people who want to do another. That's why I tried to start with the philosophy so you can see where I'm coming from. We stress that so much about the nature of growth, or so much of, let me put it this way, our understanding of why cash value grows the way it does and how premium integrates revolves around this little equation. And I know it's a kind of actuarially complex, but if we can understand that the cash value in a dividend-paying whole life contract is the net present value of the death benefit, it's what the death benefit is worth today, net of the ongoing premiums, net of that ongoing base premium, net of the costs associated with the death benefit, so much follows. Right? PUA premium, it buys additional death benefit. PUA paid up additional. We're buying additional death benefit. I can pay PUA out of my pocket, and PUA can come from the dividend. Both of those are going to increase death benefit. That new death benefit that those PUA premiums purchase is fully paid for. It's paid up, meaning that I'm not adding future cost. I'm not adding premium obligations into the future to maintain that new death benefit. So I'm increasing the magnitude of a future cash flow. I'm increasing the magnitude of the death benefit without adding to the cost, which means that I must be increasing the present value. I must be increasing the net present value of that future cash flow of the death benefit. Okay, that's why PUA premium generates cash value. It's why we want the dividend to go back into the policy, not to some rider. My opinion, we want the dividend to go back into the contract in the form of PUA to contribute to that ongoing cash value growth. In fact, the dividends way down the line, if we fund a policy like I showed you I would do in lecture 6 on case studies, those dividends down the line are going to be substantial. It also helps us understand why the idea that base premium buys death benefit but PUA buys cash is wrong. Payment of base premium does generate cash value. Does it a lot slower, but it does. In fact, in policies where a larger chunk of the annual outlay goes to base, the cash value in those policies will be greater down the line, like we showed in lecture 6. And life insurance companies can say that cash value growth is guaranteed. Why? Because it's a present valuation calculation. So long as time is going by, present values must get higher, meaning cash value must get higher. That's why James has said, I've repeated that I don't care what time of day it is. I don't care whether the markets are open or closed or whether the federal government's declared a bank holiday. So long as time is going by, cash values are going up. And wouldn't that be where we want to have our capital? But all of that follows from this little bitty equation. Given what we talked about with policy structure, we turn to those restrictions that we got to deal with, the modified endowment contract and types of term. You know my view by now. My goodness. I think long-dated level term riders are superior to annually renewing term riders, including blended term PUA riders. I want to maximize guarantees. I want to minimize uncertainty. A long-dated level term rider locks in a certain amount of temporary death benefit. It increases the death benefit so I can pay a lot of PUA, so I can build a lot of cash value in a non-MEC compliant fashion for as long as possible, to build as much cash value as possible, to maximize my cash value, to maximize my capital over the course of my lifetime. Whereas annually renewing term comes real darn close to violating the principle of insurance, because every year that puppy renews, there's a repricing of the death benefit. And if future mortality experience deviates sufficiently from the mortality experience that was assumed at the time the policy went in force, the policy owner is responsible for the difference. And if you make it worse by requiring the dividend to pay for the rider premium, then you could have a scenario where the dividend is insufficient to cover the rider premium and future mortality experience deviated beyond what was originally expected. And that every year, that recalculation is going to occur, and you could get letters like the one I showed you. Will it happen all the time? Probably not. Should you be horrified and run for the hills? Probably not. Those policies can be managed. In general, it means lower premium payment. That's the problem. Lower premium payment means lower cash value. But still positive, some. Right? So if you have one of those riders or one of those policies, it's not the end of the world. My encouragement, consider what could go differently for the next one. If you don't think you're going to buy another one, consider how you teach your kids. You don't have to agree with me. I'm just saying consider those alternatives. Most people don't there's not a lot out there saying there's different kinds of term. I've seen people say on one of these online forums, they're like, yeah, I've got a policy with, that disclosure on it that they talked about on Banking with Life, where there's a required ratio between the base and the PUA. And, the PUA can't extend so much beyond the base, but my policy has a term rider on it. Therefore, it'll be okay. No, at least not necessarily. What kind of term rider? And by the way, the presence of a term rider doesn't invalidate the ratios that companies put on when they restrict PUA relative to base. It's just, we could, but we don't know. Like I said, the market's learning. We got to talk about how there's different kinds of term riders. Maybe one's more favorable than others. Look, maybe there's other contexts for where insurance is involved outside of the IBC where annually renewing term is advisable. This is whole life insurance mechanics from the perspective of Nelson Nash's infinite banking concept, not whole life insurance mechanics from the perspective of whenever annually renewing term is advisable. And it's me talking to you. You might agree or disagree. We talked about non-forfeiture options. Look, non-forfeiture options are not talked about a lot. They're not sexy. Partial surrenders, change in the dividend election, and they're very infrequently, if ever, compared. But then we've got RPU, reduced pay up, being assumed left and right, online, all day. The least efficient, most restrictive, permanent cessation in future premium, shown all day. Because of this implicit, unspoken mindset that premium is a bad thing. So better shut it off quick. We got to talk about those non-forfeiture options. We got to compare them. If we did, and we would eventually get to the idea of a policy loan, which, as Nelson suggested, is the optimal method of deploying purchasing power embedded in your contract. Right? And we went in on rates versus volume. I'm going to be in this business for a long time. I hope and pray, so long as God lets me. We're going to get to a point where we stop dwelling on nominal rates of interest, because we're going to come to understand that the nominal rate is what it is, but how often does that interest compound into the balance of the loan? Is the loan structured? Is it unstructured? Is the interest amortized? What's the volume of interest expressed as a percentage of the loan principal? What's that number? Does that number bear any relation to the APR? We're going to get there. Very importantly, on that point, we talked about why policy loans are the most efficient credit instrument on the planet. It's the only credit transaction where the lender is guaranteeing the value of the collateral. The lender knows they're going to get repaid. The lender doesn't have to figure out ways to charge you fees to make sure that across their whole lending portfolio, they make sure to recover the amounts lost in occasional default. They know they're going to get paid. And if life insurance companies complain about not knowing when the policy loan repayments are going to be made, then they ought to change the way they govern policy loan interest, because they're the ones writing the contract. So, frankly, I don't want to hear it. We talked about non-direct and direct recognition. You know, if all we had were 1-year term riders and direct recognition contracts to sell, that's what I'd be selling. Would it be optimal? No. Hey, is a policy in 1982, pre-June 21, 1988, when we got modified endowment contracts, were those better than the ones now? Yep. Can we sell them? Nope. So we deal with what we got at a certain time and place. But in a certain time and place, we calibrate and optimize. To do so, we got to compare trade-offs. And if you know what's going on, you'll know what to do. My opinion. And look, leave my damn dividend alone. Pay me the dividend, by the way. Pay the full dividend, number one. Let it go back into the policy in the form of PUA. And I'd like to retain my authority to change my mind, too. By the way, I'm a residual claimant. I'm a member of this mutual entity. And if I want to do something else with my dividend without affecting the structure of my contract, then I ought to be. All right, so adding a rider that makes the use of the dividend the mandatory funding element for that rider, well, here we go again. Confusing what's going on in the contract with my share of the financial surplus of this mutual enterprise. No thanks. My opinion. And I did my best to wrap it. I know it took a long time. I know. Look, there are people. Bank You with Life's too long. I know. Well, it is what it is. I think we got to spend the time that's necessary to go through these examples. We talked about the phenomenon of Soviet numbers. I'm very blessed that when clients talk with me now, we're past this idea of, can you send me, the first submission is, hey, send me this illustration. Yeah, no, we're beyond that. And by the way, I don't do that. I'm not going to name names. There's people out there who say, yeah, just go around to some agents and ask them for illustrations. Okay, if you do that, you need to go around to other agents. Because that's not what I'm involved in. Why? Because there's a lot we got to cover. We got to cover the material we covered in this course. We got to talk about you. We got to make clear what the nature of these numbers are. I had an email the other day from a client. Has policies that he got from another agent. He looked at an arbitrary cash value number out at year 5 and compared it to a cash value number at an arbitrary year in a policy he got from me. And it's like, no, I mean, look, we got to take, one's direct recognition, one's non-direct recognition. The flexibility in PUA payment is different across policies. The duration of PUA premium payment is different across policies. We got to take all that into account. Right? That informs the nature, the quality of these numbers. And this will be maybe the third or fourth time I'm bringing it up. It is not financial analysis to say that because one number is bigger than another, that therefore the bigger number is better. Maybe it's an apples to oranges comparison. Right? What are we talking about? Are they Soviet numbers? Is that an authentic number? Are the premiums that result in those illustrated cash values going to be payable? Why or why not? What are the disclosures? How low is the base premium? That whole conversation doesn't happen when we jump right to an illustration. So look, I don't like this stuff online where it's, just give us a call. We'll get you an illustration. Do what you want. I don't see how that illustration could reflect a well-informed, could reflect a well-informed foundation. I don't see how in one call you're going to figure, the advisor is going to figure out everything that needs to be known about the financial circumstances and goals and habits of the individual, and how all of that should manifest in the policy structure. And very importantly, something that's often not spoken about, the terms and conditions governing PUA riders and term riders vary quite significantly across companies. And I would expect that you might find that some of the companies you hear about, the ones with the advertising budgets, in general, tend to have more restrictive PUA premium riders and may or may not, probably not, offer long-dated level term riders. I'm not saying that that's apodictically true. I'm not saying that's a law of nature. I'm just saying empirically, that's kind of what I've observed. It was very funny. I had a client. She's about to do an application to go through underwriting right now. And we go to do an illustration review at the end of our advisory process, which is where it should be. And she brought her mom on the call. Great. Turns out mom used to work for one of these well-known companies for a long time. And so I just prefaced everything saying, look, we're going to look at these numbers, but, with this particular company, as far as I know, that PUA rider is pretty restrictive. And mom laughed. She's like, yeah, I know. They know. And look, in various other insurance environments, maybe that's appropriate. And like I said, maybe you like the company, you like the advisor, whatever. Just be aware. We want to be aware of what's possible. We want to know what's going on so we know what to do. There's so much. There's so much that we didn't cover. Again, this is not all of IBC. This is very specifically the information, really an expansion upon the information that I tend to cover with each client. I know some of you are thinking, Ryan, there's no way you spend this long with every client. I don't. Let's be honest. I'd like to. I got things to do just like you do. I spend the absolutely necessary amount of time, don't get me wrong, with everybody. But in this forum, or in this format, I do have the ability to expand a bit, and I have, because I want to pour it on you. That said, there's so much we didn't talk about. Part 5 of Nelson Nash's book, and even distribution of age classes, is all about the intergenerational element. That is a huge part of IBC. That is obviously not going to be covered here. And then we've got, how do we determine the number of policies? We talked about choosing premium level and structure. Well, how many policies should I get? Should I get one? Should I get multiple? If I got multiple family members, should I get many of them? How should my desired premium be distributed across those policies? We didn't talk about that. Sorry. Premium level determination. What exactly should the premium level be? We did not do anything with with a business or household financial analysis. I often talk with my clients about learning to think like a banker. Most of us think like accountants, frankly. We look at what cash flows used to be, or historians, you could say. We look at what cash flows used to be. We don't look prospectively. Well, what's my rate of income increase generally been in the past? Is that likely to continue? Do I expect windfalls to come in the future? How far out? How confident am I in the likelihood of those windfalls? Where's that money go? Could it get into a policy now? What would that mean for the policy design right now? All that stuff matters. I think I mentioned for like a brief moment the idea of maximum insurability, maximum insurance level in the 6th lecture, because I just can't help myself. But insurable interest is, the idea of on whose life can you get a policy? Given that you can get insurance on someone's life, how much can you get? You can't just go get as much death benefit as you want and pay as much premium as you want on anybody's life. Right? It's going to be regulated typically by how much you have on your own life. And how much you can get on your own life is regulated in a sort of formulaic fashion. IBC with business cash flow. Now, I had a client yesterday. He's like, one of my concerns is, I've got a business, happens to be in the pool He represents pool like manufacturing, like he does the marketing for pool companies. And his income is variable throughout the year. Okay, well, what's that mean for premium design? It's a whole thing to say about that. If you've got seasonality or cyclical or variation in your income, if you're commission-based or just sales-based, we're going to have a separate conversation about how to determine the correct premium level. By the way, in my world, y'all, I don't tell people how much premium to pay. Y'all are going to tell me. We're going to talk about how to think about it, but you're going to tell me. Right? And what you might start off thinking it is probably going to change. And in the environment where we've got varying, maybe I'm an employee, I get bonuses at the end of the year. It's not all sales based. Maybe I have a combination of salary and variable income. All right. What's that mean for premium payment? Oh my goodness. IBC in the nonprofit setting. We mentioned this briefly in the modified endowment contract and term riders lecture. Corporations can own life insurance. In banking, it's called BOLI, bank-owned life insurance, BOLI. In the non-banking corporate world, it's called COLI, corporate-owned life insurance. I don't think there's an abbreviation for the nonprofit world, but a nonprofit is a nonprofit corporate entity. And nonprofit corporate entities have incoming cash flows. They have essentially incoming cash flow sources. And therefore, there's an argument to be made that the nonprofit entity has an insurable interest in those incoming cash flow sources. Wherever there's an insurable interest, there's an opportunity to create a policy. And those policies can be built for banking. But what are all the possibilities when I have a nonprofit entity owning the contract? And modified endowment contracts, the teeth, the really practical implications of modified endowment contracts are taxes, right? They're tax implications. Well, if the nonprofit doesn't pay taxes, then what's that mean for the design of the policy? Didn't get into that. When to expand? Nelson said it's going to take a system of policies, no question. Going to have more than one over the course of your lifetime. He had 49 at the height of his ownership. When do you go get another one? How do you know? I have an opinion on when you should. The short answer is when your income goes up, your expenses go down, or a combination of the two, such that you got money stacking up in somebody else's bank, meaning in a checking account that in a bank that you don't own. And that might sound simple or obvious, and that's great, but it contrasts with some of what's out there online. This idea of pay a high PUA for a few years and then go get another policy, regardless of what's happened to your income and expense profile. Yeah, I don't agree with that. Capital and investment / entrepreneurial opportunity. Yeah, I have so much to say about that. One of the major overlooked elements of Nelson Nash's writing is his observation that capital attracts opportunity. That the greater your degree of access to and the greater the quantity of capital influences the opportunities that come your way. We are so used to, in the conventional paradigm, chasing down opportunities. You got to hunt them down, got to find them. We're going to them rather than the opportunities coming to us. The house across the street could be an investment opportunity if you had the money to buy it. It's sort of the most rudimentary way to put it. But there's all sorts of other, the way I say it is that the landscape of economic opportunity transforms depending upon the quality of your access to capital and the amount available to you. Didn't talk much about that. I did give you the one example of how Nelson used policy loans from a state farm policy as he mentions in Building Your Warehouse of Wealth, to go buy a bunch of land and profit wildly on it. So that's one example. But I certainly have more to say. A lot can be said about IBC versus the conventional financial framework. Conventional financial framework says max out your tax qualified plan, put money in the market, go invest. What I'll say here is, and I'm not an investment advisor, like I said at the very beginning, but from an economic point of view, I am an economist. From an economic point of view, market correlated assets are exposed to the business cycle. Period. Every so often, we have these nasty little recessions and depressions thanks to the fractional reserve banking system in which we live, and the value of market correlated, meaning the value of assets that depend upon movements in the stock market, essentially, and beyond that, movements in the rate of change in the increase of the supply of money, technically speaking. That's what I mean by market correlated. The value of those assets will fluctuate. So it's a very investment-oriented framework in contemporary conventional finance. Right? We got to invest. We got to give up control over capital in this environment where the value of the assets we buy could go down. And who knows whether when it comes time to take some passive cash flow, whether or not one of those recessions or depressions will occur. But that's supposed to be the source of passive cash flow late in life. Yeah. As opposed to IBC, which in my opinion is a capitalization strategy, not an investment strategy, where we have guaranteed capital growth on a compounding basis with access in a private tax-free manner to use for what we want when we want. Right? Dividend paying whole life is non-market correlated. I don't care what's going on in the stock market. Don't care who the Fed chair is. Don't care who the president is. So long as time is passing, cash value is rising. I have a lot more to say about that. But look, this is all stuff we left out. The horse is dead. My gosh, we've beat it up for long enough. More to say for another time. I do want to make a comment about choosing an agent. Look, I think if you've read Becoming Your Own Banker, and if you've listened once, maybe more to this stuff, you're well informed, and you might be going to get another contract. So here are some recommendations for going about that process of contacting an advisor, an agent/advisor. Some people think advisor sounds more important. Advisor, yeah. Agent or advisor. Look, you want to get in touch with me? You go to griggscapitalstrategies.com, fill out the form that says get in touch. Pretty simple. If you don't want to get in touch with me, or if you want to look at who else is out there, one way to start doing that is the Nelson Nash Institute Authorized IBC Finder, available at infinitebanking.org/finder. If you were to do that and go to Finder/Griggs, I think it's 367, you'd come to my profile. But look at others. Unfortunately, on that Finder, they're arranged geographically, like state by state. Look, a life insurance agent in one state can work with people who live in other states. It just requires that agent get what's called a non-resident license in the state in which you live. That's done by paying the toll taker online. Takes about 5 minutes. Okay, so I've got clients in many states, and other agents have clients in many states as well. Consume what they put out online. Get a feel for the kind of business they do. Reflect on the qualities you might want in an advisor. And then make your selection, right? This old school way of pitting advisors against each other. You send me an illustration, and you send me an illustration, and you send me an illustration. I'm going to compare the illustrations, and then that's how I'm going to choose who I'm going to work with. My encouragement is to set that idea aside. I mean, do what you want. Do what you want. It would be, I think, as I hope I have conveyed throughout this course, there might be a less antagonistic way to go about it. We're focusing on the quality of the contract and having a conversation with an advisor who wants to have a conversation with us. I can't believe this. I have clients who come to me because they've got contracts with other agents, and the other agent won't answer the phone or respond to the emails. Now, look, I'm not on demand available, right? But You send me an email or shoot me a text or something. We'll pick a time on the calendar. We'll cover it. That confuses me. So look, talk to whomever you're thinking of working with about the nature of their ongoing service. Are you going to be available to answer calls? Who am I going to be talking to? Is it you? Is it somebody else? I come across disagreeable. I get it. You can ask nicely. But you should know. Ask about the nature of ongoing service. For a comparison, in my world, with my clients, it creates an ongoing agent-client advisory relationship, which includes ongoing complementary service. You got questions, you want to manage the policy, you want to change something on the policy to the extent that you can, you got a question about a major upcoming purchase, you can ask me. Okay? Other people do it differently. Other people have staff where they'll have staff handle questions. That may be fine. Different people have different arrangements. Just be familiar with what that looks like, because if you're thinking long term and you're going to build this system out over the course of your lifetime, it might be okay to develop a relationship with an agent you come to know well. Be aware that what life insurance agents are obligated to do is provide a suitable product. Meaning sell you a product that's suitable given your financial circumstances and goals. Okay, that's what that means. Technically, once that's done, the legal obligation is fulfilled. Now, life insurance companies set up their compensation schemes so that an agent receives some, very small, but some ongoing compensation as you continue to pay premium into the future. That's meant to incentivize the agent to provide ongoing service. Do they always? Look, many do. I'm not trying to be hard on all agents at all times. Many do. Some don't. Just want to be aware. It's kind of another thing we didn't talk about, but IBC is a unique application of life insurance. Right? We're solving for the banking function. We're implementing a capitalization strategy. The result is that the premiums can be substantial. Look, we're asking permission. We're applying for life insurance. I just finished a application the other day. Chose to write, always do write, but in this case, a lengthy 2-page cover letter to go with the application to justify why we want an exception to ordinary guidelines as far as what is ordinarily allowable for premium. If you're really intensely doing this, that may be necessary. Not always going to be necessary, but I've heard stories from underwriters and life insurance company staff of, agents who just submit the application and underwriter says, well, why this much death benefit? And the agent says, well, because IBC. That's not going to work for an underwriter. Underwriters are not agents. They're not there to advocate for the client. They're there to perform an evaluation of the application and to do so in line with commission required and company required guidelines. So an agent needs to know how to convey what you want to do in the context of IBC to the underwriter in language that they can understand and accept. And in big cases, that can mean a lot, right? That can be the difference between an application that's accepted or rejected. I hesitate to even almost to tell you this. I hear things about where a client is so enthusiastic about becoming your own banker, wants to pay such a high premium, goes and tells their agent they want to do it, and the agent says, yeah, you can't do that. And then they come to eventually make their way. They find Banking with Life. They eventually contact me. We look at the financial profile. I'm like, yeah, you can pay. In fact, the number probably needs to be higher. But because the number was so big, maybe the agent was intimidated or just not used to that kind of business. They say, yeah, it's not going to happen. That's happened like more than a handful of times over the last year. I'm like, what? Advocacy and competence in the application process. And you, agent who's listening, become familiar with the nature of those underwriters' requirements. It's in the agent manual for the company. They tell you. You just have to take what is appropriate for the client based on your involved, substantial conversation with them, put it in writing so that it conforms with what the underwriter, legitimately, don't lie, put it so that it's in the language that the underwriter can accept, so that the application, so that we maximize the chances of a successful application. That is, look, I'm sure a lot of applications are accepted and this is never a problem. Like James says, there's never a problem until there's a problem. But I know, because I've gone through it with people, that they were told no and the answer should have been yes. This last line, it's okay to pay a premium. There are folks online who will say, yeah, in order to do IBC, you need to go get a HELOC. You need to go borrow against the value of your home. Ask for money from your family members, whatever, so that you can pay a giant premium in year one. And then year two, you're going to cut it off. You're going to lower the premium down to the minimum. And, by the time you get to year 7, you're going to cut it. There's all these suggestions of, financial machinations. There's a thing called premium financing. I just went through this the other day with a client. That in order to do IBC, you got to go finance the premium. You got to borrow money from a bank to be able to pay a high premium. No, you don't have to do that. It's okay to just pay a premium. Don't have to go collateralize the house. Don't have to go do business with the bank to get more money to pay a premium. No, not necessary. So if you're hearing things like, look, in order to do this, you got to go get a HELOC, swipe left. Look, there's nothing wrong with the HELOC. I know we've talked about HELOCs, people who have HELOCs. I have clients who have HELOCs, and they're like, oh, Ryan and James don't like HELOCs. That's not what I'm saying. I'm saying that to put something, to say that in order to do IBC, you have to go get other financial instruments. No, not required. It's also okay to pay a premium, let that cash value rise. You don't have to pay a premium and go take a policy loan in week 3 to go buy a mailbox money cash flowing asset. Yes, is it the case that capital attracts opportunity? Yep. Is the fact that you started a policy and generated some cash value mean that an opportunity is going to be attracted to you in 3 weeks? No. How about in a year, 2 years, 3 years? Maybe not. Might take some time. Don't feel like you got to go pay a premium to build cash value and then you got to go do all this stuff with it. That cash value is going to grow. So long as time is going by and you're paying premium, that cash value is going to grow. So don't feel like you got to go do other things with it. Now, if you're involved in a capital intensive business or you're an investor or you have a use for that money, by all means. Might want to make sure to use a company that allows policy loans in the first year in that context. Not all of them do. All right, so just some recommendations there. Some stuff to look out for. If you want to get in touch with me, you can. I had a client the other day say, I had thought that because I did X, Y, and Z in the past, and it's messy and sloppy, and I was afraid you weren't going to take me as a client. I was afraid you were going to tell me that I have to go undo all this stuff first. No, y'all, that's what I'm here for. Like, to help you sort out your thinking about that other stuff, and to then implement the solution. So, GriggsCapitalStrategies.com, and get in touch if you want to consider becoming a client. Recommended resources, of course, becoming your own banker and building your warehouse of wealth. Basically required reading. I mean, crucial. You can get a 6.5-hour seminar recording of Nelson's DVD that's available. All of these, let's see, the first 4 things here are all available on infinitebanking.org, their online web store. Current clients, by the way, if you're a current client of mine, ask me about it. I'll give you a little discount code. But these first 4 things can be purchased from the infinitebanking.org web store. The Banking with Life DVD, James Nethery, my business partner, mentor, was the executive producer on that. But Nelson's on it, Bob Murphy's on it, Carlos Laro's in it. Some clients of James's are on it. It's great. Hour long, integrates IBC with Austrian economics very nicely in like 1 hour. So way shorter than this. The Banking with Life podcast, that's free, available wherever you get your podcasts. We do it on video as well, so it's on YouTube. Man, Understanding Money Mechanics by Bob Murphy is a phenomenal, very quick but wonderful read on the current contemporary economic system. Well, here we are in 2022. Okay, so if you're watching this in like 10 years, things may have changed. But Understanding Money Mechanics, great read. Highly recommend. Free on there's a free PDF on Mises.org. It's also okay to buy the book. In my opinion, in America's Great Depression by Murray Rothbard, part 1, I think it's 36 pages long, is probably the best, most concise treatment of what Austrian business cycle theory is. So if you're curious about more of the economics and like where I'm coming from about this business cycle stuff, that's a great place to start. Plenty more resources. At the end of Becoming Your Own Banker, there's a whole reading list. You can spend the next 5 years reading books that Nelson suggests you read. We made it. Thank y'all so much for watching. I hope this has been helpful. I've been meaning to do this for a long time. I hope it's improved your understanding, whether you agree or disagree with me. I hope it has helped you form more nuanced arguments about why you believe what you believe. I hope it helps you understand what you already own. I hope it helps you understand what you're going to own, what you may be applying for. I hope it helps you prepare to become a client of mine if you choose to do that, or to become a client of somebody else's if you choose to do that. Right? Understand that agents out there are not all going to share my views. That's okay. But I hope this, in any case, seriously, thank you for watching. Hope it was helpful. May God bless you and your family, and we will see you on the next series.